Hello everyone, my name is Rihad Hassan. My student ID is 2310336130. Today I will be presenting a comprehensive overview of the latest monetary policy statement for the Bangladesh Bank of the first half of the fiscal year 2026. This is a crucial topic for understanding our country's economic direction. So let's dive in. Here the introduction to the latest monetary policy statement from Bangladesh Bank for the first half of the fiscal year 2026. Bangladesh Bank released this policy on July 31, 2025. It's designed to tackle both global and local economic challenges. The main goals are to keep the economy stable, control inflation, and fix issues in the external sector like foreign reserves. The central bank is using a data-driven approach, meaning they will adjust policies based on what the numbers show. First, let's look at the main goals of this policy. The central bank's key objectives of the policy. The policy has three main goals. First goals are control inflation, aiming to bring it down to 6 to 7% by the end of the fiscal year. Second, support economic growth, targeting 5.5% GDP growth by helping productive sectors get credit. Third, establish the external sector, rebuilding foreign reserves and keeping the Taka exchange rate steady. Overall, it is a tight policy to fight inflation but still supports growth. Now, what's new? This policy has some important changes compared to the last half year. There are some key changes. The policy repo rate stays at 10%, showing a tight stance. The SDF rate is cut to 8% to ease liquidity. Private sector credit growth is reduced to 7.72%, while public sector is increased to 20.4%. A big change is the move to a flexible exchange rate, which should help stabilize the market. So, how does Bangladesh Bank achieve these goals? Bangladesh Bank uses several tools to manage the economy. First of all, interest rate corridor. Repo, SLF, and SDF rates guide lending and borrowing. Second, reserve requirements. CRR and SLR control how much banks can lend. Third, open market operations. Daily occasion help manage liquidity. Uh, third, third or last of all, refinance facilities, so special support for agriculture and SME to ensure they get enough credit. Next slide to now sectoral focus of the policy. Even though the policy is tight, it still supports key sectors. Uh, First sectors are agriculture gets credit to ensure food security and reduce inflation. Second, SME is supported because they create jobs and help local economies. Green finance encouraged to promote sustainable development and protect the environment. Here, Bangladesh faces several changes: high inflation, currency depreciation, low reserves, and rising bad loans. To fix this, the policy suggests better communication and data sharing to build trust. Smarter liquidity management to support key sectors. Financial sector reform to solve the bad loan problem. Boosting digital finance to reach more people and improve policy impact. In summary, this policy is focused on long-term stability, not short-term fixes. The tight stance will continue until inflation drops below 7%. Future changes will depend on inflation and exchange rate trends. Success depends on teamwork between the central bank and the government and on making structural reforms work. That's the end of my presentation. Thank you for listening.